Hi guys, my name is Vlad. I'm a real estate agent in Toronto, Ontario. My partner Mitra and I have started a brand new video series where we interview professionals that work within the real estate industry. Today we're talking to Greg Kalanjian. He's a mortgage broker with Mortgage Outlet. He runs a team there, and Mitra is asking him a few questions that are probably on your mind. Specifically, we're talking about mortgage pre-approvals. That information is coming up next.
Greg, thank you for being here today again.
Thanks for the invite, guys.
Of course, today we are going to talk about pre-approval.
Okay.
Greg, can you tell us what pre-approval means in reality?
Yeah, a good question. A pre-approval is actually based prior to the actual approval. The client tells us, he's thinking of buying a property and wants to know in advance how much he can be qualified for. So client gives us information regarding his income, his down payment. We take all that information in, we send it to the lender, and the lender issues us a letter, basically, we call the pre-approval letter, and gives us an exact idea what's the maximum purchase price the client can go for based on his how much mortgage he can be qualified for. Yeah.
Excellent. So what are three important really factors that a buyer needs to take in consideration for pre-qualification?
Yeah, so when it comes to pre-approval or any mortgage, actually, what's very important is your income, your down payment, and the subject property you're buying. So as far as income is concerned, it's very important for the broker to understand what are the sources of income of the client. When a client tells us he's making $60,000 in salary, we got to dig down deeper to understand is that a base salary, or if that part of that is bonus, or part of that is overtime, because lenders calculate different sources of income differently. So we want to make sure the mortgage amount we approve them for, it's accurate. Mm-hmm. Also for down payment, it's very important to understand how much down payment he's putting, and if it's from his own savings or it's part of his gifted, how long it's been in his account. All that information is relevant. Also, the property he's considering of buying. So if I know a client tells me he's buying for $500,000 and it's a freehold detached house, then I can be more conservative on my numbers. But if I know he's going for a condo purchase, then I know I should have a maintenance fee to account for. So that can kind of skew the numbers, the mortgage amount approved. So I got to know, the more I know up front, the better I can prepare, and the more accurate the number will be on my letter. Yeah.
Great. So what would you say that a potential buyer needs for any pre-approval documentation?
Yeah. So for a buyer, it's very important is, keep all your documentation for the down payment handy, the 90 days history. Don't move money around between accounts because it creates a verification nightmare. So keep it there. Talk to your mortgage broker in advance. Make sure your credit is clean. So sometimes we work with a client and they're ready to buy in a few months from now. So that's fine. But as long as we look at your credits up front, or your client can pull up their own credit, we make sure everything is minimum balances, the credit is clean. Different lenders have different requirements. So the last thing we want to do is when the time comes to make the offer, we have surprises. So let's work with you. Let's make sure your credit is good, your down payment is safe, your employment documentations we need up front, you have it ready, your T4s, your tax papers are all ready, we have it available, then we can go pre-approval. So this way the amount is approved is very accurate, and you can count on it when you're making an offer.
Okay,
Yeah.
great. So Greg, when do you think a potential buyer can start applying for a mortgage pre-approval?
I would ideally say at least 90 days in advance, start for it, because pre-approvals usually are valid 90 to 120 days. So you have that time period. First, you're qualified. Second, you can protect your mortgage rate in case the mortgage rates goes higher. If it goes lower, then it's fine. But if it goes higher, you're protected that way. Also, some clients, we say 90 days minimum, ideally, because some clients, for the down payments reasons, they want to contribute to our RSPs to take advantage of first-time home buyers plan. And when you contribute that, it has to stay in the plan for 90 days. So basically, 90 days is preferred, or 120 days. The sooner the better. So the more we know your situation up front, we can be ready for it when it comes.
Outstanding.
Yeah.
Thank you for being here today, Greg.
Absolutely. Thanks for the invite.
Of course.
Thank you very much.
That's about it, guys. Thanks for sticking with us. If you like what we had to say, please hit that like button, consider subscribing, and hit the notification bell so as not to miss any new releases that are coming out every single week. Please comment in the comment section below so we can improve our game and deliver more material that is of interest to you. See you again next week.